Let's understand what is open-ended and close-ended schemes. When we talk about open-ended schemes, the first scheme the usual investment product that comes in our mind is mutual fund. So open-ended mutual fund accepts fund from investors by offering its units or shares on a continuing basis. You can go and invest in mutual fund at any given point of time. It permits investors to withdraw funds on a continuing basis. Under a repurchase agreement, you can withdraw from your mutual fund at any given point of time. There's no lock-in period, there's no restriction. Such schemes have no maturity period and are ordinarily not listed. But when we talk about close-ended scheme, it is kept open only for a limited period, let's say from 1 month to 3 months. Usually that's the period, that's the duration for which the scheme is open for you to invest into. It does not allow investors to withdraw fund as and when they like. That means it doesn't provide enough liquidity. It has a fixed maturity period, usually between 5 to 15 years, and these schemes are listed on the secondary market. So mutual funds are not listed on security market, that's open-ended scheme, but close-ended schemes are usually listed on secondary market. In next video, we are going to see what is the asset mix of mutual funds.